Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions.
All right, welcome to Market Call. I'm Dan Nathan. That's Peter Bookvar of Bleakley Advisor. He also runs the book report every day in your email box. We're going to get into that. You can have that, subscribe to that. It's one of those reads that you must do. Peter, welcome to Market Call.
Thanks, Dan. Great to be here with you.
All right, you and I get to talk a lot. I get to read you every day. I get to see you on CNBC. What's going on here today, I think it's fantastic if you are a holder of stocks, if you've had to weather the volatility that we've had since the highs in February 19, which were made worse on April 2nd. And, that sort of sell-off that we had over the next couple of weeks in stocks. We saw a rise in treasury yields. We saw the dollar get destroyed. We're seeing some of that recalibration, obviously, over the last week with a really strong emphasis today. All right, give us the 411, Peter, on what your expectations were into the weekend, into the China-U.S. negotiations, and where we are coming out of it. And then you and I will parse through some of the math.
So I thought that the tariff rates would be down to like 50, call it, which is still a punitive rate, which is still an embargo type rate. But I thought that that would be sort of the rate that would take the edge off. Cooler heads would enter the room, and there would be more of a conversation. Of course, we got greater than that, both on what we tariff China and what they tariff us. So the 10% baseline stays with China. These are on top of the 2018 tariffs, where most of them are still in place. This also does not include steel and aluminum and cars. Not that China exports cars to us, but that's not included here. So the 10% and then added another 20% with the fentanyl used reason to combine the tariff rate to 30%, while China lowered their tariff rate and our stuff down to 10. Now, keep in mind, we import about $450 billion worth of stuff from China. Mm-hmm. So we are paying most of the tariff rate because we import more than the $150 billion that they import from us, which is a lot of it is energy and ag. So China understands that they lowering their tariff rate down to 10 actually benefits them because it lowers the import cost to them. Now we have the 90 days for discussions. What these discussions will look like, your guess is as good as mine. Or are we going to have a legitimate deal where Trump sort of implements what the Chinese did not follow through with in the 2018-2019 discussions? Like, they did not fulfill a lot of the agreement in terms of agriculture purchases, IP protection, and so on. So we need to see some meat on the bones here with regards to these negotiations.
All right, that's a really important point. So in 2018, in March, Trump put the first real meaningful tariffs on China. We did not have a phased one deal until January of 2020, so nearly 2 years, right? So when you just said, do they follow through? There's really no basis, right, to believe that they might do that, aside from the fact that their economy is super weak right now. It's much weaker than it was in 2018. We can agree on that, right? So for them,
well, yes, it's weaker, but they've spent the last 7 years preparing for this moment. So while they're not immune and they're getting hurt, and the property sector has been weaker, they have their tech sector is far and away what it was in 2018. Their dominance in EVs and robotics and solar, and it is a much more higher value add manufacturing base than it was in 2018.
Right. And so the important part of that, though, during this last, call it 6-7 years, they've also spent hundreds of billions of dollars, maybe trillions, building out more manufacturing capabilities, right? So they are basically, I think they're responsible maybe for 30% of the world's, exports, or you know what I mean, like that of manufacturing. Excuse me, 30% of the global manufacturing. They'd obviously like that to be a bit bigger. Your point about technology is a super important one. I think going back to January with DeepSeek and the ways in which they had innovated over there, developing their own generative AI technology, but it goes way beyond that, manufacturing of higher end electronics and the like, which is EVs, and so a lot of stuff is going on there, which actually makes it more important that we figure out this bilateral relationship, right? So like that is important to me. But the other aspect that you just mentioned is that we import $450 billion or so from China. That is basically, I don't know, is that like 2/3 of what we import from Mexico and Canada? I think. Does that sound about right? I think combined there may be 800 billion or something like that. So at the end of the day, we are more interested in what's going on with China because they are an adversary of us rather than an ally on each side of our borders. Does that make some sense?
Yeah, for sure. But we also are hugely reliant on China for many of those imports because China did not become a manufacturing powerhouse just because.
Mhm.
They didn't become what they became just because of subsidies. Now, Russia, the USSR subsidized their economy. North Korea subsidizes their economy. They didn't become manufacturing powerhouses. So there are certain things that China was able to make for a lot of US companies, whether it was a US company that relied on China for an intermediate term good, or it was a US company that relied on China for a finished product that they sold at retail here, for example, or to somebody else's supply chain. They became very good at what they did, and it was very difficult to all of a sudden snap your finger and have Bangladesh or Vietnam or Indonesia replicate what was created in China. So, that gets to the stupidity of putting a massive tariff and embargo on China within a week.
Yeah.
Because what business is able to pivot? Now, if you said you have 2 years, okay, well, that's one thing. But if you have a week, or else too bad, well, that's a major problem. So the rollout of this was stupid.
Yeah.
I'll be honest, and but luckily, we pulled it back, and we'll see where it goes
All
from
right.
here.
We pulled it back, but like think about it going back 2 months ago. Okay. So if you're a business and you were basically trying to figure out what this new tax would be on you, what you were able to absorb or push, or you know what I mean, or have your customer, right? Like, absorb, right? And it wasn't going to be pretty, which is one of the reasons why we saw this dramatic decrease, right, in shipping coming to the US. We've heard what that meant in the port of, Los Angeles and the sort of way it kind of works through intermodal and that sort of thing, right? Do we have any sense though that that's going to change a whole heck of a lot, even with a 30 or 40% tariff? And again, I'm not sure, and I got to figure out as the day goes on whether the 30% rate is including what we already had as a base rate and what the fentanyl tariffs were, right? So if that would make it like 50, but if it's 50, I mean, and this is what Paul Tudor Jones said on CNBC last week. He said he expects it to go down to 50. Does that change a whole heck of a lot for US importers? Because if you think about it, these 145% rates just took effect, I want to say a couple weeks ago. So the ability for these companies to kind of change their mind on some of the kind of import decisions that they were making, or the way that they were hiring and CapEx and R&D, the way they were kind of pulling, are they going to turn on a dime right now based on this announcement this morning?
So a couple things to that. I think on a sustainable basis, if you are some toy company in the US that sourced your product in China, I think maybe you can get by at most with a 20% tariff on that imported product. Maybe you can figure out a way to pass it on to an extent and figure out other ways to cut costs, maybe. But you can't go past that. You can't go past a 20% tax on this stuff. And you talk to many small businesses that source in China, and while they may want to go somewhere else to get their product from, it is just not a feasible thing for many years. Because even Vietnam, which has been this extraordinary manufacturing growth story, taking a lot of market share from China, they still can't get to where a lot of US businesses want them to be in terms of sourcing product. I think now that we have 30, there are just some things that are still going to stop in terms of trade. Now, there are other businesses that there was no way they can absorb anything north of 50, let alone 30, but there'll be some businesses in the US that will be able to handle 30%, particularly with respect to intermediate term goods. So I think over the next 90 days, there is going to be a massive rush of ordering from Chinese factories to get everything they can to stock as many shelves as we can in the US from these China factories.
Yeah.
So what you're going to see is you're going to see transportation costs skyrocket. I can't even imagine what's going on today with trying to procure a ship or a 40-foot container to get stuff here over the next 90 days. Because that also got into the discussions here, because if you're trying to plan for back to school and especially Christmas, a lot of those orders had to be in before June 1st or maybe latest June 30th. So the administration was running, what president is going to want to oversee not enough toys in the shelves for Christmas or empty shelves within the next 30 days, which we were certainly heading for. So you're going to see a massive rush. Now, if you're a business that says, okay, this is my opportunity to get all the product I need for Christmas, great. But you still have the 90-day uncertainty about what happens past that, where the end up rate will be in terms of tariffs, because like I said, really anything north of 20 is punitive. So I think the point is that the only thing we've had this year is just distortive, manipulative, uncertain, upside down economic policy. That how do you run a business within this? It's just extraordinarily difficult. And let alone, we also have the reciprocal tariffs on everybody else that comes into effect either, I think, July 2nd or July 9th. I think July 9th was the pause, but maybe that's as of July 2nd. So where this all goes, we know based on the deal announced with the UK, actually it wasn't even a deal, it was a term sheet. We're going to have a 10% minimum rate. Now, why? I don't know. But that's obviously the rate that they are seemingly coalescing around, with probably higher rates above that for some countries and the 10% for others. But 10% is still a lot.
Yeah. Well, all right. So there are a couple of things here. We're going to get to the markets. One of the things that has really aggravated me about this, and the way in which the rollout, we can all agree that it was suboptimal, and the volatility that it caused, not just in the stock market, but currency markets, in gold, in the treasury market. This was pretty haywire, right? And I think that they, for some reason, did not think the ones who were kind of rejiggering this trade policy, I don't think they thought that was going to happen. They said they weren't concerned about the stock market. There could be some short-term pain. They were targeting the 10-year US Treasury yield. Well, it did the exact opposite of what they were hoping to do, and they blinked. Like, make no mistake about it. What made me mad is that obviously, they had no idea like it was going to go that way. But, a lot of folks, you say this is like, okay, well, we're back. Okay, we're back to those April 2nd levels. Yeah, but if the selling, all right, let's look at this. Okay. Who the hell was selling, from that breakdown at 5,700? Real people are affected by this, like their 401ks and their IRAs and all that sort of stuff. Trust me, people, that wasn't just hedge funds, blah, blah, doing this, selling and buying back and this and that, whatever. Like, this was a lot of algorithmic trading, right? And so if you're a retail investor, you kind of got chopped up here, right? And so one of the things that I always get frustrated about in the markets, especially in this case, where it was literally, self-induced by the government that's supposed to be a steady hand here, that, the little guy gets screwed here. There's no doubt about it, because I think in some way, shape, or form, no matter what you hold in those retirement accounts, there was some suboptimal trading that went on. And it might not have been a qualitative decision by some portfolio manager. It might have been some it might not have been some, I don't know if I said that right. It might not have been some qualitative decision by a portfolio manager, but a quantitative one when you see all of these risk assets moving the way in which they did. Okay. So a lot of folks were focused, if you're looking at the technicals here, on that flattening 200-day moving average. You see the V reversal that we've gotten really comfortable with over the last sort of, 5-6 years or so. We're gapped above that. You better hope that we hold here, right? And then I say to myself, I still can't see what gets us back to the prior highs because, yeah, that Q1 GDP is going to get explained away, probably gets changed up a little bit. And Q2 is probably fine based on a lot of the guidance that we heard out of a lot of companies. But again, if you got chopped up and you were force sold, down there at 5,000, and now you're reconsidering buying back, 5,800 or something like that. That sucks, Peter. It's like, speak to that a little bit, because at Bleakley Advisor, you guys manage lots of people's money, and you probably heard from a lot of people about what the hell is going on here. I have never seen the market. I got to go back to COVID, and then I got to go back to the fall of 2008, where I can remember this amount of disconnect, right, in the markets here.
Yeah. So a couple things, and behind that S&P chart, there are actual businesses where people go to work every day and try to provide a service or a product to a customer that, imagine how their lives have been turned upside down over the past couple months with this chaos. So there are a couple of things that have changed here. To your point about why I agree we're not going back to the highs. Number one, just to quantify what a 10% lasting tariff would be on all imported goods. So right now, we import about in 2024, we imported about $3.3 trillion of goods. Well, a 10% tariff would obviously imply, all else equal, $330 billion of a tax, because that's what it is. It's a tax on companies. Just to put that in context, in 2024, the US government, in terms of income tax receipts on the corporate side, took in about $525 billion, give or take, of corporate income taxes. Now, what I did today was just a back of the envelope, unsophisticated analysis and say, okay, if we took in about $525 billion of income on taxes on a 21% rate, some people pay more, some people pay less, but on average, that implies a $2.5 trillion pre-tax income number. So you add on the 330 billion on top of the 520, so you get to about 850. Well, of taxes that our companies are paying, that 850 divided by the 2.5 trillion is 34%. So all of a sudden, a 10% tariff on imported goods. Now, some companies are not going to pay that tariff because they don't import. Maybe they provide a local service like a local gym, for example. But generally speaking, the 10% blanket tariff essentially raised, in the aggregate, the corporate income tax rate to 34%. It was 35 before Trump cut it down to 21. Okay, so we have that context of the impact of that 10%. The other thing, before we even heard about tariffs, you mentioned, we talked about offline the DeepSeek news. To me, that ended the Mag 7 trade in terms of the one decision investment that these stocks made, and the ability of these stocks to drag the S&P 500. So when you look at this chart, right before the DeepSeek news, or quickly after, we peaked right around that news, because then you started to lose the AI tech trade. And then Tesla, of course, had its own challenges. And now we know that Google search is having their challenges. And there was no Apple Intelligence upgrade cycle. The point is that this whole group splintered. And when you're talking about losing the leadership of 35% of the S&P 500, you better quickly find other things to replace it. And that is not such an easy do within the next couple months. And I'll argue we've actually replaced it with international stocks right now that aren't in the S&P. Then I'll throw in one more thing. One of the major drivers of economic growth over the last couple of years, and corporate earnings growth and corporate profit margin expansion, has been enormous government spending. Well, we know we need to get U.S. government finances on a better path. We know $2 trillion and 7% deficits relative to GDP are unsustainable. And I think the administration is going to try to slow the pace of government spending. And that's a good thing long term. But in the short term, that has negative economic implications for all the things I just mentioned. So losing the Mag 7 trade, losing that fiscal impetus of massive spend that happened under both Trump 1 and Biden. So they're both to blame. And then also now that 10% tariff rate, we're not going back to 22 times earnings. We are not going to achieve what people thought earnings would be this year relative to what they thought in December of what it was 270. I think you're going to be looking below 250 and maybe even closer to 230 if the economy rolls over. So they're important big time trends. And I have to add this. Foreigners owned about $30 trillion of US stocks, corporate bonds, and treasuries coming into this year. I can't wait to see the updated 13 Fs and Ds to see what the rate of change has been in foreign holdings of US stocks. The weakness in the dollar is just not out of nowhere. It is happening coincident with money going back home being outside the US, whether that was reflected in the spike in the Taiwanese dollar, whether that is Europeans that are taking their money home, and we've seen a sharp rise in the euro, whether that's the US 10-year, which is getting back to testing 4.5% again. Foreign money is getting trimmed. And you lose that sort of bid from foreign money, that's another thing why I don't believe we're going back to the highs in the S&P, with more of a question of, do we retest the lows, or are we just going to chop between 4,800 and 6,000 for the rest of the year? I don't know the answer to that, but I think I've laid out enough reason to believe that we're not going back to the highs for a while.
Yeah. It's funny. I was out with a friend of mine late last week who is one of those folks who talks to a lot of those billionaire investors, and we heard some pretty bearish stuff from some of them. Paul Tudor Jones last week said he thinks we retest the lows. I think there was some other commentary, and my friend said, "Yeah, but they always sound like that in periods like this," which I thought is kind of interesting. And they get a lot of noise. They come on Squawk Box and they say their thing, and people get a bit freaked out. It gets written up, and if you're just kind of not in the markets and you hear this, you don't know who Paul Tudor Jones is, but you hear that he's a legendary macro trader over the last 50 years. He's made billions of dollars. You're likely to kind of take some stock of that. Our main man Doug Cass over there at Seabreeze, he writes for thestreetpro.com, and he's always given us a lot of great tidbits. He just emails me here, Peter, and he says, "Tell Pete I say hi." And so here's what he wanted me to ask you. There is a strong possibility that this morning's peak headlines are similar to the opposite headlines that produce the April market volatility to the downside. So do you see that? He's also saying that, this exceeded his upside target. I know he was picking at things. He thought maybe we get to 5750 in the S&P. Guy also was in that camp. For me, I guess I was more bearish on the economy than I was on the markets, but another point of this, and we've been saying this consistently over the last month or so, that this is not the opportunity probably to sell as things were getting crazier. There's probably the opportunity to dollar cost average on the way down, because if you're one of these market participants who's not looking at the markets day to day, it took you a week to really understand between April 2nd and April 9th, really what was going on, right? Yeah, the stock market was selling off. Gold was making new highs. The 10-year US Treasury yield was, 450, then 455, then 4.6, right? A whole host of other things. The dollar, broke and was down below, 5-year lows or so, whatever the hell it was. Like, those are things that most people who are not paying attention to the stock market on a day-to-day basis, they don't, and I don't say this in a condescending way, it's just not a mosaic that they're familiar with, right? All they see week over week is that the stock market's selling off. So the question you probably get at Bleakley, or a lot of our friends who are RIAs and the like here, is like, do I sell? And a lot of folks that I knew were not saying to do that, which is why I don't think these were qualitative decisions. They were more quantitative. So how do you kind of combat that? You take a longer term time horizon than the 90-day reprieve that you might get on tariffs. And you say, is the market going to be higher in a year or two? And, we have to go back 20 some years to remember a protracted bear market. People forget 2008 was the only year during the financial crisis that the stock market was down. In 2020, COVID, Black Swan, the stock market wasn't even down. Like, think about that, right? And so 2022, we had a very, very orderly bear market, right? It was down 20% in the S&P 500, and then it bottomed less than a year. That was the one day it sold up. The jury's still out on 2025. You know what I mean? Like, we could have that year, but the S&P is basically down 1% right now. The NASDAQ's down 7%. You could say that's not so bad if we see a cooling off of this Mag 7 trade, which powered 2 consecutive years of 25% returns in the S&P 500. And you say to yourself, all right, we were 6150, 2.5 months ago, and now we're 5850. And we have all these geniuses in Washington trying to reorient global trade for the future and get our tech sector on the right side of things relative to China. I mean, the list goes on and on. You could say no harm, no foul, right? I mean, there is an argument to be made. But to Doug's point, what does it mean that the 10-year U.S. Treasury yield has not sold off today? That is basically at 4.45. We're at 4.46, which was, or 4.6, excuse me, which was the reason why we saw Washington blink, or the White House blink. What does this mean to you right now in the 10-year? And do you agree with Doug about basically saying that we sell these levels just like you were to buy the other levels a month ago?
All right. So you make an important point on the qualitative versus quantitative, because I will tell you firsthand, the retail psychology remains, okay, the market will sell off, but it always comes back. The market always comes back. It's like people think that it is a God-given right that, yeah, we're going to go through a storm, but it always comes back, because that typically is what has happened. But, this V bottom coming back, we're not, it's coming back at a pretty rapid pace. So yes, it was more quantitative sellers rather than retail saying, okay, I need to reallocate my portfolio. I think to Dougie's question, and I agree, because when you think about where we were at 4,800, that was peak chaos in terms of the scattershot approach and tariff rate bonanza. And now we've sort of more contained the chaos and sort of defining what a potential worst case scenario will be. And that being, okay, the best case is 10%. And I just outlined why a 10% tax on imports is going to take the corporate income tax rate from 21 to 34 and is going to be a major drag. But at least you can quantify the drag. But on the other hand, it's still negative. So we've sort of reached peak containment in a way. So I do agree that from here on out, well, the best case is that 10%, which is not so good.
Yeah.
And if the negotiations with China don't go so well, and we don't get what we think we want to get, well, then that's a problem. And we're still stuck with steel and aluminum. And we're still stuck with auto tariffs. And we're still stuck with whatever negotiation comes of the EU. So basically, next after this, we have to deal with the economic consequences of what we've just layered on to the US economy and the global economy.
Yeah.
So getting from here on out, from a fundamental factor and catalyst that would take us higher, I think we've priced in a lot of the good news with only the negative to now sort of flow through. And I do want to highlight, because I know you and Guy have talked about this, we cannot separate out the ancestral nature of the stock market and the economy. That probably wasn't that much of an economic hit because we were only at 4,800 for a short period of time. But if, and I emphasize, if we retest that, and if we break it, and if we don't have another V-shaped recovery, upper income spending is the other leg to the stool of this U.S. economic growth story.
Yeah.
I mentioned we're going to lose the impetus of fiscal government spending if that AI tech spend just even flatlines from here. Therefore, you don't get that incremental growth rate. Well, that sort of lift to economic activity, while still robust, you don't get that rate of change increase. And if you lose that upper income spend because you fail up at 5,800 and you head back down to 5,000, that in itself can become a self-fulfilling prophecy that negatively impacts economic activity, earnings, and then the stock market. So we are, I believe, on a fragile foundation right now where we are not going back to December 2024 for a variety of these reasons. Therefore, every investor needs to start asking themselves, and we know one of the hardest things to do in this business is trying to figure out what is the right multiple. What's the right multiple on an index? What's the right multiple on an individual stock? But I'm going to say with confidence that we're not going back to 22.5 times forward earnings for a variety of these factors we talked about. Where it ends up, I don't know. But I just know that the valuation pendulum doesn't just get knocked down by one or two turns. It usually happens more than that. And whether it's going to be 16, 17, 18, I don't know. And good luck trying to predict what that earnings number is going to be this year. Now, obviously, I'm talking from an index perspective, but just from a company perspective, it's extraordinarily difficult. And the companies are telling you themselves. You listen to a slew of conference calls, and companies are either widening the range of guidance dramatically, or your United Airlines and says, okay, if the economy turns down, we'll make $7 to $9 a share, and everything's fine, we'll make 11 to 13. Well, you can drive a truck through that. And some companies are just saying, you know what, we're pulling guidance.
Yeah.
Well, how do you what multiple do you put on no guidance?
Yeah, but Peter, and we were highlighting this. Our main man John Butters over at FactSet, he was tracking this, and we had some of this data over the last 2 weeks. There wasn't as many companies as you would have thought that A, pulled guidance, or B, guided down, or had guidance that you could drive a truck through. And that's one thing that I took away.
Well, it was isolated in those that were mostly affected by trade. The U.S. economy still at the end of the day is mostly services. So there's more visibility on having a service heavy economy than otherwise.
Yeah, and I get all that. I mean, I would have gotten a lot more negative if we didn't see the quarters, and I get the pull forward, and maybe you don't see that in services as you do as much as goods, right? And that was one of the reasons why Apple had such a great quarter, or good enough, you know what I mean, that sort of thing. But I didn't see the lack of visibility that I expected to hear, you know what I mean, on those.
I'll add one thing to that. What I did hear a lot in earnings calls was, for those companies that did give guidance, they said, this is our guidance.
Yeah.
Or this is our guidance range. It does not assume a recession. It does not assume any deterioration in the economy from here. That caveat is qualitative, doesn't make it necessarily into what Butters is saying on his quantitative.
Yep.
So there was it was that caveat that this is our guidance based on what we're seeing right now. Any deterioration in the economy or any pickup in the economy is not included in this guidance.
Yeah, it'll be interesting to see, when we get the next consumer confidence readings, small business confidence, and then future inflation expectations. They will be backward looking, right? So, in some ways, it'll be really interesting data, and it'll be interesting to see how the markets, respond to that. On the multiple front, Doug also said this. I think it's interesting. He's of the camp, and it sounds like you were in that camp, that S&P earnings for 2025 are still too elevated, especially with interest rates are rising, which he means he brings it back. And he's made this point really well over the last 6 to 9 months. The equity risk premiums getting ever thinner, a major market hurdle. And I know that's, an area where you play. The other thing I think is interesting when I'm looking, and Amanda can pull up the Fateful Eight here for a second, and the performance. I mean, these were obviously some of the biggest gainers today on the day, and certainly in market cap terms. And, Microsoft is underperforming. It's one that had a huge gap last week. And I got to tell you, the more I dig into that quarter, the less interesting it was. I know it's probably a conference call that you spent a lot of time on. I mean, the company came out. the CFO and then Satya reiterated this, is that it wasn't their AI products that drove the upside in their cloud business. It was actually more capacity came online for Azure, the cloud business, and therefore there was more demand for that. They couldn't have been more clear about that. Amy Hood, the CFO, in the Q&A, she said, I want to correct something that was, you know what I mean? Like that was, so that 8% gap, shocking to me, underperforming here. If Amanda wants to show the sectors now, where we're seeing some of the underperformance, this is where you would expect it: consumer staples, telcos, utilities, some real estate stuff there. So this was some of the higher yielding stuff. This was deemed to be more defensive. So not a huge surprise here. And then the last thing I just want to, kind of mention is like stocks like Netflix, Spotify. These were things I saw at 9:33 this morning that were down. Walmart was down. Costco was down. These were some of the names that were benefiting from the perceived, sort of scarcity or some of the other issues that you want to mention. CME Group was down almost immediately. This is a stock that was benefiting from all the volatility and all the products that they have in the futures markets that were used for hedging and, and a whole host of other, speculative sort of reasons. So I thought that was all pretty interesting.
Can I ask Amanda to bring up one chart?
Of course.
Amanda, in my notes, scroll down because I included the top 10 holdings of the Norges Bank. Because I'm going to tie in what you just said about the Faithful Eight with where the dollar goes from here is hugely important. Where foreign flows go is hugely important. Now, this is a foreign central bank. This is their investment arm. This is as of December 31st. These are their holdings. If foreigners decide that they want to trim their ownership of U.S. assets because they got way, way over their skis and way, way over allocated, just a pendulum and mean reversion swinging in the other direction, these numbers are going to change. And that's why I mentioned earlier, I look forward to seeing the updated 13 F and Ds because foreigners made these stocks a reserve asset. And that's why if you think the sell-off in the S&P is over, you're going to say, okay, well, foreigners are done selling.
Yeah. Well, and so just to be clear, so Norges is one of the largest sovereign wealth funds out of Norway, correct? And so, they're loaded up on the Mag 7, Faithful 8, whatever you want to call them. And it looks like every mega trend is being reflected here in these top 10 holdings. Now, to your point about, of course, these were like big sellers. I'd be shocked to see if we saw, these sorts of weightings in their portfolio when those come out. Now, maybe these are the sort of folks that are loading back up on it. But the other point I would say is that you talk about dollar asset selling. If the dollar were to sell off, if yields in the 10-year were to start to go higher, there's no way the stock market can kind of maintain these sorts of levels because that's the sort of price action that we saw in early to mid-April. But the last thing I'll say here is that no matter what has gone on between the UK a week ago, now with this China trade deal, if the EU holds out, if Mexico and Canada hold out, right? Like we're in a scenario here where we have, as a nation, when you think about our defense, commitments to NATO and what's going on over there, there's a lack of trust here. There's a level of volatility that if you are, being browbeat into investing in America, you might commit to that sort of stuff over the next 2.5 years or so, right? The way that we've seen no shortage of SoftBank, and the list goes on and on of these companies that were meant to do this. But it really creates a level of volatility in the, I guess, the commitment of us to this international democratic world order that we have helped establish or led in over the last 80 years. That this thing, what's kind of making the markets move today, is not something that to me is particularly reassuring that we are going to be that sort of stable sort of hand the way we have for years and years. All that said, okay, is like, if the 10-year, and to your point about, the dollar and stuff, if this can't hold, this rally in the dollar, I mean, the 10-year is something different or this, then we got a real problem. So again, I'm not rooting for that by any means. I'm not positioned for that way. I am glad that the financial markets have stabilized to some degree here, and hopefully it can kind of hold out because that's not the way that I am betting right here. Before we get out of here, I know we got to get out of here. You mentioned foreign stocks. where are you? Like, what markets are you most interested still? If we're seeing this risk on trade back in the US, let's just say it kind of holds here and maybe we're kind of, go sideways until we get more economic data, until we get more, sort of clarity on what comes after 90 days, we get more clarity on earnings and that sort of thing. Where are you as far as where you want to be allocated globally?
So the rethink of foreign ownership of US assets is going to benefit international markets. And we've also lit a fire underneath global economies in terms of their need to grow their own economy and rely less on the US. And Europe, for example, I mean, even Europe understands that they've been suffocating under red tape, bureaucracy, and regulation. They are going to make an attempt to grow faster. China, we blew up in to their benefit, not to our detriment, their technology sector, where in the next couple of years they're going to do everything that we're going to be able to do here, and that Huawei is going to be competing with NVIDIA selling chips around the world. So my point is that for the first time in many years, investing outside the U.S. is now working. So we own stocks in Europe. We own Veolia Environment, some boring ones, Nestle. I own JC Decaux, which is the out-of-home billboard company based in Paris. Oil companies, if you want to have some overseas exposure in terms of where they're domiciled, BP and Shell in the UK. There's just a laundry list of companies outside the US that are really attractive. In Asia, I find Singapore, Vietnam, Japan, even stocks in China, particularly the Macau casino stocks, very attractive. In fact, with all the worries about the Chinese economy, Macau numbers out of Golden Week were very strong, with gross gaming revenue getting back to near its 2019 levels. There are a lot of opportunities outside the US. I'm not saying don't invest in the US. There are plenty of opportunities too in the US, but the whole world now is our investing oyster. Whereas prior to January 2025, for the DeepSeek news, all the money was concentrated in just a few names. Now we have a lot more investing choices.
Yeah. And let's just do Fed for a second. Amanda will pull up the CME Fed Watch tool here. So June 18th, the next FOMC meeting, you see this a near certainty that they are not going to be cutting interest rates. Does that surprise you? We haven't seen any movement there. And then when you get to July, it's kind of like 55-45 sort of thing. So we were pricing last week 25 basis points cuts, right? For the most part. Now it's just a little bit more than that. Maybe Amanda can pull up the chart of the day that we have here. I think it's from Sober Look, daily, whatever we call that, the daily, what is it? The daily shot. Thoughts here on the Fed and what you think has changed from the Fed presser last Wednesday, if anything at all, and what we might see as we go into the June meeting and then again in July.
Well, put your feet in Powell's shoes. Well, Trump just gave China a 90-day respite.
Mm-hmm.
Well, Jay Powell is saying, okay, I'll take 90 days off too, because I want to see how these negotiations play out. Because the last thing I want to do is get stuck cutting rates because I'm worried about growth. But then in day 60, day 70, day 80, there's some China deal and everything ends up being okay and the economy rebounds. Then I'm sort of caught in one direction. So he has told us that he's as clueless as the rest of us are on how this plays out. And he'd rather have more confidence and clarity on what policy is and how inflation responds to the tariff rates, how economic activity responds to this before he reacts, because he doesn't want to lean in one direction and have to pull it back.
Yeah. Let me ask you this. If he had not cut last fall, okay, well, we had 100 basis points of cuts, right? We had the 50 and then 25 basis points. Do you think, though, right now, and I know it's a counterfactual, who gives a crap? Do you think that given, just some of the commentary that we've heard over the last few weeks and some of the data that's getting, easily on the inflation front, although the uncertainty is what a protracted trade war would mean for inflation, right? So this is one of the reasons why he's taken a step back, and then throw in the pressure that he's gotten from the White House. If we were at 5.5% on the upper end, would they have been considering cutting over the last couple of meetings, or the June meeting? You know what I mean? If you think about it following, or I'm just curious how you think about that, because in hindsight, a lot of folks were saying, oh, that was so political if you think about September and November, and then obviously did again in December. But at the end of the day, can you imagine if he had taken the same stance as he has over the last 4 or 5 months, and we had an interest rate, a Fed funds rate at 5.5%?
Yeah, it's an interesting question, and thought provoking. I actually think that he would have cut, but I want to emphasize though, he would have taken the same sort of messaging approach as he did with the 100.
Mhm.
And I thought this too. Like, I thought last year when they started that it was going to be more of a rate tweaking cycle rather than a rate cutting cycle. And I think that ended up being the case then. And I think if he would have been cutting now, it would have been sort of that same thing, is that I'm going to take the edge off a bit to our very high Fed funds rate because the rate of inflation is much lower. And even if it ticks up because of the tariffs, I still have room. But the days of just slashing and burning interest rates and using QE, and those days are over. And this, for now, and will continue to be, is a rate tweaking cycle. And if there's one lesson the Fed also learned is just because you want to lower short-term interest rates doesn't mean long-term interest rates this time around are going to accommodate you.
Yeah, I agree. Really quickly, again, I keep saying really quickly because I have your ear here, or I have you, giving us some great stuff here. We had a question, and it's on banks, and let me just see. It's from Chris L. Would love to hear your opine on the XLF, maybe less on the XLF, Peter, and more on the BKX. If Amanda can pull up a chart here. This was one that, in March already started to break down, maybe in anticipation of the trade war, broke below 125. We had a bit of a rebound, and then we just kind of broke really hard, right? From 127 down to 100. I mean, think about that, and think of it from 140 to 100 that we saw from the February highs to the lows. This is easily one of the hardest hit groups in the entire market, let's say X that kind of fateful 8 or so. How are you thinking about financials? Because until we broke that 200-day moving average on those 2 occasions in March and early April, this was one of the best looking, if you think about the uptrend sort of areas. It was one of the better sectors that we saw in that first week of April, or I guess April 11th is when they started reporting as far as results and the commentary about the consumer. So thoughts here on financials, on banks in particular.
I think the investor focus right now with banks has shifted to credit quality, and credit quality, both at the household level and the corporate level. And how is small and medium-sized businesses going to manage this current economic environment? How will lower to middle income consumers, which have been more challenged, going to manage through? And where the labor market goes, because we know people start losing their jobs, they're less inclined to pay their credit card bill. So right now, the banks are just going to be a trading sausage, I guess, more than anything. But I think that is, from a fundamental standpoint, where my focus is when it comes to investing in these banks.
All right. Housekeeping. June 5th. Fast Money Live. It was an event that we did February 27th, and there was so much demand for it. It was this amazing event where if you bought a ticket, you came to the NASDAQ 4:00 on the day of a show. We had a Q&A with Melissa Lee and the producer Sandy Canold at 5 o'clock. It was a live watch party. Guy Adami went in the crowd and took a bunch of questions that were answered live on air. Then afterwards, we did a panel with the traders, with Melissa. I think that lasted for nearly an hour, tons of Q&A. And then we had a cocktail hour. It was an amazing event. We had so much demand for the second one, for a second one. We have a few tickets left. We have a promo code for our users, our listeners. Go to fastmoneylive.cnbc.com. The promo code is capital F, capital M 25. Get a nice discount there. It was a great event. We don't have many tickets left. We wanted to make sure we gave our listeners, our viewers, the potential for the discount. They've been very generous to do that for us, and we want to make sure you guys and gals have the opportunity to do that. Peter, pretty great having you here today. It was a really important day in the market. I really hope things hold here, because if they give back a bunch of it at the end of the day, and they are holding right now, we're up 2.5% in the S&P 500. It's the 10-year that would be a bugaboo for me going higher, and it would be the dollar selling off. All right, last question. I promise you. What are you doing with gold at 3,200, down from 3,500?
I'm still a big bull, and it's not to own because you're worried about geopolitics or chaotic markets. It's gold has become the most, I agree, right now, the most important central bank reserve asset to own. And if there is a rethink in the US dollar and US assets, which I think there clearly is, that's going to still create a nice bid for gold. And the highs are not in yet.
All right, love it. Back up the try. Listen, I'd love it to see it go to 3,000, and that I'm not a gold bug, you know that. And I just say if it kind of retraced that uptrend that's been in place, that would be something. You back up the truck. That's another 7% lower. I know that seems like a lot in an instrument like gold, but look at the way it had been going up. So maybe you'll have the opportunity to kind of dollar cost average on the way down. Going back to the commentary that we had about trust in the U.S., trust in us, whether it be financial markets, defense. I mean, the whole host of other things going on. It just feels like, to your point, gold is going to continue to work. Okay, Peter Boockvar, thank you so much. Guys, go to the Book Report. You can have his commentary every day in your email box. I've been reading it since the day that it started. Also, Doug Cass, we can't say this enough. I love that you watch. Guy loves that you watch, but we love your input and your helpful sort of tidbits there on a daily basis. And Doug at thestreetpro.com, he is about as transparent as it gets there, people. He will admit when he's wrong. He's probably right a lot more than he's wrong, but we appreciate
Daily must read, Dougie Cass.
Yeah, it really is, as is the Book Report. So thanks, everyone, for being with us. Guy Adami will be back tomorrow, so we'll see you tomorrow. Thanks so much.